Good morning, everyone. And like the other speakers, I want to thank Sydney. I've been doing Sydney's conferences since they started also, and he's a terrific resource for the entire crowdfunding ecosystem, an ecosystem that is growing larger and larger. Okay, to introduce myself, I'm Mark Roderick. I'm a lawyer with a firm called Flaster Greenberg. I spend all my time in the crowdfunding space and have for the past few years. I have a blog, and that blog is obviously available to anyone with the internet, and as a result, I'm very busy, and I get calls and emails from around the world every day, including Russia. I will say right up front, I do get calls from Russia. And so the reason I say that is that the information, the inputs I get from people are have become, I think, statistically significant. It's not anecdotal at this point because I speak with so many people who are coming into the crowdfunding ecosystem or wanting to learn about it. So I think that I see trends, and I'm going to talk about some of those trends this morning. The caption of my presentation this morning is Regulation A, and I'm going to talk a little bit about that, but I'm not going to talk exclusively about that. So the most important thing I want to say is that there is no such thing as Regulation A+. That is fake news. It's Regulation A, and I say that because, as I'm sure the other lawyers in this room get calls and they say, well, I'm not sure whether I want to use Regulation A or Regulation A+, and things like that. So there's actually some confusion out there in the marketplace about what Regulation A and Regulation A+ are, respectively. And I will just clear that up. Regulation A has been around forever. As part of the Jobs Act, Congress ordered the SEC to improve Regulation A. And when it was improved, it began to be referred to as Regulation A+, but it's not. It's just Regulation A improved, okay? So that's the most important takeaway from this speech. Okay, the big point that I want to make this morning is that we all in this room, by virtue of what we do and whom we represent, we all tend to view this space, crowdfunding, this phenomenon, from the perspective of issuers. And in fact, when we talk about it, and when legislators talk about it, we talk about giving entrepreneurs, real estate developers, and others access to capital. And that's all well and good. But I want to suggest that there's a better way, a more productive way to look at this space, and that is through the other end of the telescope, which is what this space is about is giving ordinary retail investors access to investment opportunities that they have never had before. Mark Roderick, for example. I've been practicing law, since about 1840, I always say. And I represent lots of entrepreneurs and lots of real estate developers. But never before have I personally had the opportunity to invest in the deals that I'm investing in now. I've invested in a lot of crowdfunding deals and am continuing to move more and more of my multi-billion-dollar portfolio in that direction, including my friend Eddie Lauren here, we're about to get his Regulation A multifamily deal qualified by the SEC. Terrific investment. I'm not here to plug his investment. It certainly, yeah, he says, okay, it's certainly not the only one that I've invested in. But view it through that lens. View it through the lens of making great deals available to retail investors. Because if we don't, then we're not going to make capital accessible to entrepreneurs, right? Because retail investors today have access to lots of things. They have access to the public stock market, right? They have access to privately traded REITs. But those are, relatively speaking, bad investments. So those companies, public companies, they have access to capital. Privately traded REITs have access to capital. But it doesn't work because those deals are not good deals for ordinary retail investors. So I'm just going to suggest that's the paradigm that our industry should be looking at through that end of the telescope. Make the deals good, and we will, that's really what our industry needs. Okay, just a tiny bit about Regulation A for no one in the room, but speaking to the camera for people who might not know the basics. Regulation A now allows issuers to raise up to $50 million a year without going through a full-blown IPO. And it's interesting that you can view Regulation A as either of two things, and which of them you view it as sort of colors your interpretation of the entire industry. One, if you come from the small company syndication market, you view Regulation A as a really big private placement. And if you come from the public company, Wall Street industry, you view it as a really tiny IPO. And it really does, which of those views of it you take colors your perspective on lots of things. And I don't have an answer. I'm not going to tell you, yes, it's one or yes, it's the other. It's both, but they are not necessarily consistent in terms of what kind of rules you would like to see. It depends on which end of the, which of those two choices you've made. Okay, the Regulation A market is very, very healthy, I would say. It became, the changes became effective only in June of 2015. We have lots and lots of issuers coming into the market. I get lots and lots of calls from would-be Regulation A issuers. So that's great. The SEC so far, in general in crowdfunding, and specifically with respect to the Regulation A piece of crowdfunding, the SEC has done a fantastic job. First, of interpreting a very broad congressional mandate in a way that makes Regulation A much easier than it might otherwise have been. And second, at least until recently, of getting offerings through the SEC bureaucracy pretty quickly. Now, I will say, and I'll ask others in the audience, my recent experience is that things are getting bogged down. We used to see on an initial filing, they'd respond in 28 days, on each subsequent filing within 10 days. We are seeing that really starting to get stretched out. Is that your experience, Brian? Yeah. So that's a problem, and of course that's even before the budget cuts come through. So that cutting the SEC's budget could really hamstring this industry. I will say that. So it's a very healthy market, lots of issuers, lots of interest from issuers, lots of good deals. Another friend and client, George, did a great deal. Yours was qualified last year. Another great investment that I made personally. So there are terrific deals out there. Brian mentioned the Fundrise REITs, the Realty Mogul REITs. But the issue, as Dara said, is distribution. So the first question that I ask people who call me and say, well, we're thinking about a Regulation A offering is, how are you going to sell it? So, I mean, it's okay. It's a big issue of how all these things are going to be distributed. But I think in general, the Regulation A market is working pretty well. That's a sort of big picture observation. And indeed, I would say, another big picture observation, the entire Jobs Act market, the entire crowdfunding market is working pretty darn well. If in 2012, someone had told us, when the Jobs Act was signed into law, that we would have this much volume, this many players, this much innovation, I think we would all have found that a pretty optimistic prediction. So personally, I'm pretty happy with where things are now. Now, the question is, where does it go from here? And in particular, how does the industry scale? And in particular, how do and why do retail investors come into the market? Again, viewing this from the perspective of the investors rather than the issuers. Why do retail investors come into the market? They certainly come in because they speak to their friends and they find out their friend is getting a 9% yield or a 12% yield, and that sounds really terrific. And, you know, I think investors are mainly driven by pack behavior. So we'll probably see a big, you know, you'll see a little trickle, 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 and then a big movement. However, as an industry, we need to ask ourselves what we are doing for investors. And today, the answer is not a great deal. That is to say, if you go to a typical offering on a typical crowdfunding website, you find documents that investors either are not going to read, right? Or even if they tried to read, could not read. You find impenetrable legal disclosures that investors simply can't read. And indeed, on almost all the sites, you know, one of the, not secrets, but sort of wink, wink secret of the industry, you go to the site and you sign up for the deal. There are lots of sites where you're asked to press the Invest Now button before you see the disclosure documents, right? So they're sort of just acknowledging without, they're not even thinking about it, that we're not giving the information to the investors before they decide to invest. The disclosures are just there as insurance. No one's going to pay any attention to them. No one's going to read them. So that's a real issue. We don't give investors information in a format or at a time that they can read. And I've sort of advocated to my clients without a lot of success that they should do it differently. The disclosures should be done in a really cool, visual way so investors can click through them and, you know, learn all about the deal. That is not how the industry works. At best, before you click on Invest Now, you get about a quarter of a screen with a 150-page PDF. And next to it, it says sign here. And sort of that's how it's done. So that's not a good model for investors. We as an industry should fix that. But more importantly is this. This is a big picture issue. Most investors, Mark Roderick included, are not capable of evaluating businesses, are not capable of evaluating deals, even what seem like pretty simple deals, right? I've been representing real estate developers my entire career, since 1840. If you show me two apartment buildings, even in the same city, Austin, Texas, apartment 1, apartment 2. And you give me all the due diligence you have. Mark Roderick is not really capable of telling you which of those is the better deal. The real estate developer, he or she, whose business it is, can tell you, or at least can make a very educated guess. Mark Roderick doesn't know. So there's a fallacy. The industry is built on the fallacy that even if we did and could give investors very understandable, accessible disclosure, that they would be able to make good decisions. That's not true. And so as an industry, what do we do about that? And I'm not sure. I have written on my blog several times, where are the freaking investment advisors for the crowdfunding space? Why doesn't somebody hold himself or herself out as an investment advisor for crowdfunded offerings? And I don't know the answer. Maybe there's just not enough money involved. I can't tell you how many calls I've received, and I bet Brian and Sarah have as well, and every other lawyer in the space. I have a great idea. I'm going to raise money and create an investment fund for crowdfunding deals. Terrific idea, except you can't do it because it's an investment company. But the way around that is to become an investment advisor for the space, and so far that hasn't happened. We talk about fintech. This is sort of about the intersection of finance and technology. The question is, what can technology do for our industry? It has certainly made the subscribing process a lot easier than it used to be using FedEx. What more could it do? I mean, I'm asking that question rhetorically. I can name two things that potentially it could do. One is we could use technology to do due diligence on deals, okay? And to some extent that's happening certainly in the peer-to-peer lending space. That's how they do due diligence. They run some data through their algorithms and they come out with a lending club score or a Prosper score. The question is, can that be done on a more widespread basis? And it seems to me that that is the way for the industry to scale, and probably the only way for the industry to scale. And second, conceivably, I'm talking about investors not being able to read offering materials. Is there a way that artificial intelligence could be used to help investors identify the key pieces of deals from the offering materials? Possibly. But beyond that, the question is, what can technology do for our industry? I will just say three more quick points. One, personally, I think a secondary market is far away. Even if we had a legal structure that made it mechanically legal and easy, you need, for a real secondary market, you need a lot of buyers and sellers. So for example, we have lots of companies, the pink sheet companies, they're in a perfectly legal place. You can buy and sell them. It doesn't matter. There aren't enough buyers. So until we have a lot more buyers in this space, it seems to me that the secondary market is some distance off. Second small point, I think we are moving in the direction, absolutely must move in the direction, where all of the crowdfunding portals offer all three flavors, Title II, Title III, Title IV. Platforms are like retail stores. They're like DSW, except they sell securities rather than shoes. And they need to be available to both their suppliers, the entrepreneurs, and their customers, the investors. They need to be providing the full range of shoes. They can't just say, well, we're only going to sell that segment of shoe because their competitor across the street is going to sell more, and that's going to be the end of them. And finally, coming back to the investor-oriented paradigm, we're in Washington, D.C., so we think about proposed legislation. And we have the Fixed Crowdfunding Act, and we have various other legislation in the House Finance Committee that would loosen restrictions and thereby, according to the authors, make capital more available to entrepreneurs. Just want to remember, this is about investors. So what we really need for this industry, we need a market that is safe for investors, right? The most heavily regulated states in our country, California being one, New Jersey, where I live, being another, are also the wealthiest, okay? And I would argue that is not a coincidence. When consumers feel safe, they spend money. Back when I was young, if your horse and buggy broke 3 days after you bought it, there was nothing you could do. Then, maybe 25 years ago, we started to get lemon laws. And of course, the auto manufacturers said, oh, it's going to kill our business. It's terrible, government regulation. Well, what happened? We got the lemon laws. People buy more cars. It used to be when you bought merchandise at a retail store, you couldn't return it. If you're old enough, you remember most places you couldn't return stuff. Now you can return everything. And what happens? People buy more stuff, okay? They return some of it, but net, retailers make more money. It is a little counterintuitive, but from a crowdfunding perspective, I think we can all sense that if retail investors feel safe, they are much more likely to invest. And the more protections you strip away, the more you make it a laissez-faire market, the less they're going to invest. I know that is not really a popular position within our industry, but if you think about how it works for everything else, all the other goods and services in our economy, there's no reason that it's going to work differently for retail investment. It has to be safe, and I hope everyone in this room will help make it safe in the year to come. That's all I have to say. Thank you.